You have a fantastic voice. If you ever want to do a career in ASMR, I don't know if you know what that is, but
No, I don't actually. But thank you.
you check out ASMR.
Isn't that
You
like
will,
people watch like people opening like
yeah,
jars and putting
but the
their
ones
hands?
I like are the unintentional ones where people are talking just in a nice, calm manner. You have a
Oh,
fantastic
okay.
voice for that. Welcome, everybody. I am Jason Trost, the host of the Business of Betting podcast. I'm really excited for today's guest, Soo Kim, who's the managing partner and chief investment officer at Standard General, better known as being involved with Bally's. His name comes up a lot in the industry. He's been doing a lot of M&A. He's been doing a lot of moves in the US, and I can't wait to get his perspective. He's very busy with all the things he's doing, and I'm really happy that you've made time for us today. So thanks for joining us on the
Of course,
podcast, Sue.
Jason. Thank you for having me.
Yeah, of course. So why don't we just kick off? Why don't you just introduce yourself in your own words, your background, and what brought you to the sports betting industry?
Yeah, sure. So my name is Soo Kim, and I guess I'm wearing the hat of the chairman of Bally's, where the represent the large shareholder. My fund does, based here in New York, but been involved in Bally's and its predecessor, Twin River, for the past about 12 years or so, actually. As that company was emerging from a reorganization, we bought its securities as a private company. Over the first 5 years of that company, really when it was a single casino based outside of Rhode Island, slowly but surely built up a position. After about 5 years or so, became the largest shareholder, joined the board, and then I became chair at the end of 2019. So I think I joined the board in 2016. So I've been involved in the company's evolution, but also really in some ways the evolution of gaming itself in the States. We went from a single casino to adding our second casino, which was in Biloxi, Mississippi in 2015. And then, fast forward a couple of years and we had four casinos, one we built and one we bought. And then, currently we own 15 casinos. We're also in the process of buying or building two more, one in the city of Chicago, another one in State College, Pennsylvania. And but also at the end of 2021, we closed on the acquisition of GameSys, or the fourth quarter of 2021, and by doing so became a major player in online gaming internationally. And the company currently makes a little more than half of its operating profits on the casino side in the US, and a little less than that on the international interactive side, but primarily not sports, actually. Um, the way we came to sports is obviously in the US, online gaming regulations is sports led. Feels like there continues to be a federal prohibition, the Wire Act, that prevents intrastate gaming of any form. Within the state, sports betting is now permissible in something like 35 states or so. And that's important because that's really the entree to online gaming. Period. Just mobile sports betting. Just drop the sports and it's mobile betting or mobile gaming. And so in North America, you absolutely have to have a sports strategy because it's a sports led market.
So just to get into a question I've always been curious about, maybe this is a little bit inside baseball, but Standard General, is it a hedge fund? Is it private equity? Is it private capital? What kind of entity is Standard General?
It's actually we have both. We primarily set up as a hedge fund, but we also do have private drawdown funds. So the hedge fund does have the ability to do public and private. So um, the largest investments that we have are public. However, we just have large positions in them. So because of our sort of hybrid nature, we've had the flexibility doing longer term investments, public to private, private to public, and all that really comes from our heritage of doing long term turnaround and distressed investing. That's the core of the company, and so um, a position like Twin River actually started as a distressed investment, and that over time, slowly but surely, became a publicly traded company. But throughout the period of time, we maintained our position as the largest shareholder, and sort of like the sort of had a reasonable role in which strategic direction the company took.
Got it. And so as a hedge fund, you have outside capital, and
Yeah,
I imagine. Yeah, and I imagine you have a 2 and 20 fee structure or something similar to
it's
that.
similar to that. Yeah,
What are the assets under management public, or is that private information?
it's public. I mean, we manage about $1 billion right now.
Okay. And so I mean, that's essentially been your background. The last 15, 20 years is running this hedge fund. Yeah.
Correct.
And so how do you go from, when I think of hedge funds, and maybe this is naive or oversimplified, but I think of hedge funds more as having, trading strategies, long, short, buying this, selling this. Like, to me, owning and selling companies is more like this might be a oversimplistic model, but I think of like Berkshire Hathaway or, some slow moving private equity companies. Is it the fact that, hedge fund, it's just sort of more the structure of the outside capital that makes it a hedge fund than
Yeah.
necessarily the strategy?
Well, I think you answered your own question. It is. It's more the structure of the capital than the strategy. The catch-all hedge funds themselves have evolved over the years. I mean, part of it is just that we have actually a relatively old hedge fund. I've been up for, I don't know, close to 17 years now. And I've been in the business for more than 25. It's really just broadly classed as alternatives. And again, we're more, situational or opportunistic than asset class driven. So we invest in both loans, bonds, and equities. And we're defined by the kind of situations we enter, which are troubled companies, stressed, de-stressed, turnaround, special situations. So, and the way that the securities that we trade to get there are less important than the situation the companies are in. So there aren't, I do think that there aren't that many funds like ours now around, because it's part of it is just we've just been around for a long time. So back then, I want to say that there was a little bit more flexibility and a little less. And as the business has grown, I would say the categorizations have become a little more rigid. So we still don't quite fit into the classic categories just because we're so sort of old and grandfathered and sort of like the slightly older, more of a catch-all. But the one thing I just want to point out is that the public markets are actually longer term than private market investors. So if you think about the economic incentives of any kind of draw fund investor, from all the way from early stage angel VC all the way to straight LBO private equity, you make an investment and then you don't actually cash out a fee until that not only that investment is completely liquidated, but that entire fund is liquidated. And so even though these funds have lives of, I don't know, 7, 10 years or something like that, the optimal time for a classic private equity investor to invest and monetize is about 3 years actually, which is a long time, but it's not like it's obviously it's longer than the hedge fund that trades for a day. Oh, I'm going to position this thing, a week later, earnings, boom, I'm going to trade out of it.
So when I hear distressed, my other misconception or conception is that distressed is high risk. Is that a fair way to think of distressed, or is distressed has return profiles similar to other asset classes? And then my second part of that question is, do you have to have high risk tolerance investors and LPs, or do you have the traditional blend of pensions and hedge fund pensions and endowments and things like that?
Yeah, look, all potential investments live along a continuum of risk versus reward. It's not about high risk or low risk. It's about your ratio of risk to return, So you can take something that's very low risk and get a low return, and that should be comparable to, say, something at a medium risk, a medium return, and a high risk and a high return. So first of all, every investment in the grand scheme of investment potential, from treasuries all the way to commodities, all the way to real estate, all the way to a venture growth investment, all of those live within the continuum of risk versus return. So assuming that they all have the right ratio of risk versus return, right? Then the only question is, do they complement each other, supplement each other? Are they? And so when you're building a portfolio, you need to make sure that your individual risk reward decisions do not correlate to each other. That's slightly the most important thing, actually. So what you're trying to do when you create a portfolio is to create a portfolio of uncorrelated risks returns that fit along that spectrum. So these are all the theoreticals. But look, when you talk about distressed and turnaround investing, there are certain risks that come with that, meaning at the end you have, the business itself is at risk, right? So you just can't wake up in the morning and know that you've sold X amount of burgers and charge X fee for a software service or something like that. You can't do that. But in terms of, but the markets are efficient, in terms of charging you, what is that risk versus return ratio. And so, yes, if it's an amazing business model, you're probably trading at like 25 times earnings, more. And then your risks are different. You don't have your risk of the underlying business. Your risk is more that like interest rates move 5% and you're totally screwed.
You can swear on this podcast.
Yeah,
It's
yeah.
fine.
Well, whatever. I mean, you go from 25 times earnings to 15 times earnings, just because interest rates moved 3 points, and 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 that had nothing to do with your underlying belief or analysis in the business. A distressed investment tends to be priced as such because the markets are generally efficient. So you're not going to pay for excitement. You're not paying for. So the one protection you have is, we invest in things that are at actually very low multiples. 5, 6. Like just maybe less, maybe one or two, maybe as high as 9 or something. And that's a reflection of the rate of return that you think theoretically you need to invest in a situation that has those kind of variables. I mean, look, I've been doing this for 25 years, so I don't really know anything else in that way, right? I think it's crazy to speculate on interest rates or commodities or any sorts of things that you have no control over. To me, I am a believer that the risks that I take for myself and my clients are the ones that I have some modicum of control over. So, look, I can make bad decisions, and look, we make, look, we've made many a mistake. I mean, it's just the nature of investing is, even if you're a genius investor and you're getting it right like 55, 60% of the time, that means you're getting it wrong a bunch of times. You just have to make sure you're minimizing your losses when you get it wrong. That you're sizing your winners correctly. There's lots of different ways to get from point A to point B. You only get here if you are surviving and delivering market or better return, right? There's nothing inherently more risky about a distressed asset because everything, Jason, is at a price, right? So if someone says, would you buy a building that's burning or you buy a building that's brand new? And you're like, I will always take a brand new building. That's not actually true. The question is, how much? So if somebody says, I will pay you $1 for that, I will give you $1 for that burning building, and you have a bucket, of water, and the building is just smoking, it's not really burning, and you're like, all right, here's $1, hold my beer, and if you're saying like, oh, that's a brand new spanking building, but you have to spend, $1 billion for it, you're like, is that without risk? I don't know the answer. Maybe there's a pandemic and then it's empty the next day, right?
That pricing example really resonates with me. To me, that's the same thing with sports betting, where a lot of times people think about, oh, the Patriots are playing well, or the Patriots are not playing well. I like this bet or don't like this bet. And what people don't realize is that every bet is worth taking it at the right price.
Right. Yeah, absolutely.
So that's something that resonates a lot with me. So I kind of know you. I believe your position is chair of the board for
Yes.
Bally's, right? So I mean, I kind of know you more as that title. Like when you wake up in the morning, are you a hedge fund guy that dabbles in gambling, or are you now a chair of a gambling company that also has a hedge fund on the side? I'm just curious how you internalize that.
Bally's is, I don't want to say about 20, maybe a little more, a percent of our assets. No, I wake up as an investment manager. That's my primary fiduciary goal. And I also serve as chair of Bally. So now that's a fiduciary role as well, but I'm a fiduciary to our own interests, right? Because I mean, nobody cares more about where the shares and the values of Bally's goes than ourselves. And so we're completely aligned in that sense. And I don't even take a fee. So most directors take a fee. I don't even take a fee because I'm paid by my own clients if Bally's goes up. So really part of me doing my job as an investment manager for Standard General is actually making sure that Bally's performs. There's no incongruence in that. You just have to make sure that you don't spend all your time at Bally's, or you don't spend none of the time at Bally's, right? If you're going to spend none of the time, and you're going to spend none of your time, then you shouldn't be on the board. If you're just going to spend all your time, then maybe you should consider just working on Bally's and have a single fund and not worry about the rest of your investment. So I think that there's a balance. We've been doing this for a while, so I believe that we have some level of balance we've achieved, but it's dynamic, right? And I have to make sure that I'm always getting it right every morning.
How operational are you? I mean, I see that you guys changed CEOs not too long ago. Like, are you getting involved in the weeds of running the business, or are you in a more hands-off strategic kind of role?
Look, we represent the largest shareholder, and I happen to also have a good relationship with the other large shareholder. So I represent all the shareholders, really. The role of a board is oversight and accountability. That's the role, incentivization. It's like it's not to do; it's to make sure that you have the right team that are doing the prioritizations that you've laid out for them. So we try our best not to get involved in the day-to-day. Let me tell you, if your board is getting involved in the day-to-day, then something horrible is going on with your management team. You know, your management team should be operating so that you don't have to worry about, the day-to-day. And remember, this is not dissimilar to using sports analogies. I mean, like it's like the difference between a manager and a player, right? I mean, you cannot, or a coach, you're not on the field. You're actually not on the field. You choose what the plays are. You choose who plays them, who's on the field. So we choose who's on the field. That's the role of the board. But we don't actually play. Look, I mean, you just talked about, like, do we made a change? Well, yes, we made a change because a year and a half into our merger, we looked back and we thought about all of the strategic goals that we set to ourselves before the merger closed, and when the merger was announced, before it closed, after it closed. That's a 2-year period where we have a pretty good sense of what we accomplished and what we didn't accomplish. And frankly, we weren't happy. We didn't make enough progress in our North American sports effort, and that was for a multitude of reasons. Look, we are luckily the casino business, the North American casino business, is running still on all cylinders. Luckily, the international interactive business is doing well. Clearly, North American interactive has been disappointing. We've lost, a reasonable amount of money, but even more than the money we've lost time. The net of it is we have not been pleased with our, North American interactive, outcomes and rollout, and we're not willing to cede that business or keep doing it the way we've done it. And so we've restructured, and I think that's not the last of it, and hopefully we'll get that position going in the right way.
So if I could just pull the layers back a little bit, when I I'm the founder of my company, and there was two big things that I wanted to do with markets when I founded it. One was I wanted to use betting markets for public interest markets. I found trading on elections fascinating, and I still think betting markets are the best tool for prognostication of future events. Super interesting, but very underutilized in society. The second thing that was really motivating to me is the bid offer spread, or basically the margin that the customer paid, just to me seemed insane. I used to be a stock trader, and we were fighting for pennies, and then I saw sports betting, and there's 8% transaction fee every time you're placing a trade, and I was like, who pays this? And it turns out a lot of people pay this, and it's fucking insane, frankly. So those are the kind of like those. Obviously I wanted to make money. Obviously I'm a capitalist and I want to build my business, but I had this really kind of intrinsic need to kind of bring my business hypothesis to the market to try to see if, the market agreed with me is basically what I'm trying to do as an entrepreneur. As a professional investment manager, your goal is to return capital to your investors. How do you layer on what you're trying to do with Bally's? Like, if Bally's could sell hamburgers and make $1 billion, would you do that? Or do you have a very specific thesis with Bally's of, we want to be the best at this, and this is not, yes, of course I'm trying to make money, but this is why I'm here, and this is why I'm spending my time on this?
Yeah, I mean, well, first of all, if we can make $1 billion selling burgers, of course we do it. And I don't think there's anything mutually exclusive about that. We do have a thesis in the sense that the Bally's is I think the first company that is equal parts online gaming and physical gaming, and we set that up on purpose, which, by the way, is in some ways a sacrifice or a position, or itself, because remember, the public markets typically like pure plays, right? And that's just a market theory that look, if I want online gaming, I'll buy the online game guy, and if I want mobile, physical gaming, I'll buy the physical gaming guy. So when we say, hey, we're going to present a company that's half half, people are like, well, I don't like that, because I might have to be buying something I don't want. So we take a step back in the public markets, to make that statement. But the reason why I think that's important is because I really truly believe it's just gaming. It's not casino gaming, it's not online gaming, it's just gaming. And gaming is a wonderful business. It's clear to me that casino gaming complements online gaming. It's not it doesn't cannibalize, they don't cannibalize each other, which is really interesting because most businesses that go digital see a decline in the analog, but gaming is not like that. You can look at Jersey, Michigan, Pennsylvania, where you've had massive growth in online gaming and sports gaming, and yet casino gaming has remained relatively stable, if not, it continues to grow. So just
When you say casino, you mean in person?
physical gaming.
Yeah.
Yes, exactly. So I think it's a remarkable. Now I saw that, and that's by the way, that's still playing out, and I think this was remarkable. There just are very few businesses, and remember, part of it is I am, this is the perspective I have of investing in things other than gaming, and the reason why I'm so attracted to gaming is because I'm watching this digitalization of gaming, mobilization of gaming, the removal of gaming, or the delimiting, where technology and regulatory advancement takes the limits from a physical place-based thing to you could do it anytime on your phone, and yet doesn't take away from the physical place-based thing.
You're trying to make the argument that Bally's is the winning, or your hypothesis is that the winning formula is to combine the physical and the online
Absolutely.
experience in one.
Absolutely. I see that the two businesses are supplementary, not in any way antagonistic to each other, which is bizarre. It also
Symbiotic, in other words.
Yes, and it also takes remember, casino gaming in North America is a GDP type business. It's stable, it kind of booms and busts. You get a little bit of expansion, but in the end, it's just it's a GDP business, right? So now you layer in online gaming, that's not a GDP, that's a plus 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 business. And so, but the assets from physical gaming, including the brand, the customer base, the interactions, the physical social interactions you could only have at a casino, the destinations and the regional convenience, all of the assets of a casino company, both destination and regional, your relationship with the regulators, the fact that many states your online licenses actually flow through the casinos as incumbents. These are all important assets that casino companies can bring to the online game. They're not dispositive, because obviously being an online player, gives you that nimbleness, that focus of, that can, potentially lead to better outcomes, definitely in the short term. But we posit that these are not separate businesses. They're similar businesses, and they will help each other, whether because physical casinos will help with the problem of online, customer capture, whether it's, the online gives growth to a business that doesn't actually have growth. They're complementary efforts. And I think that, when technology catches up, which it hasn't, and we've worked a lot on this to really break down the barriers between online gaming and physical gaming.
How do you see yourself differing from, the MGMs and the Caesars and the Penn Nationals that, have an offline online kind of approach to it?
I don't see myself differing from those folks at all in the long run at all. I think everyone's going to come the same way. If I had to tick through those, I guess it would be that MGM obviously has a JV for their business. Caesars owns it, and what's called Penn does some, it does a little bit of leasing and a little bit of ownership too. So it's a mix of the both. I don't think that, again, in any of those, only differential is that we just have a higher percentage coming from current interactive revenues, in our case internationally. So we probably have we have an international bent that those guys don't have. Although MGM and Caesars does develop outside the U.S. We have an international bent, and then we also have just a heavier owned, it's called interactive bent, which is a little different. I mean, again, in Caesars has a substantial interactive effort, but at the same time, none of that's going to matter as much as the 95% plus of the operating profit that come from the casinos. So it's just a matter of percentages. Like we have a higher percentage.
So Bally's has been, at least in the last couple of years, very well known for doing lots of acquisitions. You have Monkey Knife Fight and BetWorks and GameSys. With the lens of your hypothesis, if I understand you correctly, is that the marriage of online and offline is a good business model. Like, what role did your acquisition strategy play in that?
Well, I think I mean, we wanted to own as much of the chain as we could have. That was our initial thesis that, in the end, the percentage takes by the third party service providers would be so high that, it would be hard to capture value of your customers. Remember, you're generating the customers through your network. And then if you toss it onto your online business, which you don't control fully or has a lower margin because there's a lot of people that take from that chain, then you may never make money there. So our initial view was, let's go and buy all the technology ourselves to try to have a vertically integrated, sports betting, free to play, all, as much as many places we can go, knowing full well that we weren't paying full prices. We're paying for what I think we're to be, generously considered like the kernel of something that we can build upon. We spent actually more money in operational burn, developing, integrating these technologies and trying to move them forward last year than we spent on any individual asset. So, so we have, Bally Games has had we've cut a little bit. I think we're still over 1,000 developers.
Yeah, I guess one of the advantages of investing in public companies is that you can have instant liquidity, but one of the disadvantages is that your scorecard's public. So your stock has gotten beat up a little bit, I think somewhat just because of, interest rates and, the macro environment has deteriorated, but also like the shine has come off a little bit in the industry. Granted, it was super hyped 2 years ago, 3 years ago for some good reasons, but the shine has come off a little bit. Can you talk about how you think about getting the share price back up? Because ultimately that's your
That's
goal.
all I care about. Just so you know, that's all I care about. I mean, the strategy is strategies or tactics or decisions or people, all that are inputs to getting the stock up. That's the only output that matters. Yeah, I mean, look, it's sort of interesting because again, this one is one where conceptually, we don't have to go after North American Interactive. We shut everything down and take every dollar we have to, buy back stock and pay down debt, return capital, and the prices are so much lower, and that's actually a pretty good move. But we're trying to be balanced. There still is a bright future in interactive and in blending our casino to interactive. And so we're just trying to keep, the balance between short-term incentives and long-term incentives. Clearly, our stock is down. Look, it peaked at 70 something in 21, and now it's at under 20. It's a joke. It's interesting because if at the beginning of 22, so last year, their stock was at $38, and it closed just under 20, or something like that, so it's down 50%. The number that we had targeted for operating profits from the casino and the online casino, we pretty much hit it. Had you told me in Jan 1 of 22 that I would hit the number or very close to it, and our stock would be down 50%, I'd be like, what are you talking about, man? Like our stock's already down from 70 to 38, and that's what the market
interest
is.
rates, man.
Yeah, no, I know. I mean, it's just everything going on.
Who knew they had that much of an effect?
It's disappointing in the short term. It's disappointing for me personally, but we have the faith, right? I mean, we built this thing up from zero. Look, we built this company up from a company that was worth $300 million, and now our market cap's $1 billion. So it's got $3 billion debt, so it's worth $4 billion. So okay, it was at one point worth $7 billion, and it will, we believe it'll get back there. So I mean, I still like our cards. I like our team. I don't see anything that makes me upset. Because you're right.
Yeah.
If I did, I could just sell.
So you mentioned earlier in the podcast, public markets hate conglomerates. They like pure plays, which I totally, think you're nailing you're hitting the nail on the head in that one. So like, have you thought about, having separating the physical and the online business, and, sort of like, I guess like Virgin does. You have Virgin Galactic stock and, Virgin X stock. Like, have you thought about doing that to kind of?
We think about all things that would be good for shareholders. Just because we were not able in that first sort of year or year and a half to execute on this plan of of synergizing physical to online, that doesn't mean that that's invalid, you know. And I think we're still very early in that thesis. I think you're not wrong that if we're wrong, just like we can buy businesses, invest in them, and then shut them down if we feel like they're not working, we're not going to keep investing, and we're not going to This is the same thing here. Like, this decision is reversible. You're pointing out easily reversible, but.
And sports bet, I mean, we spent a lot of time talking about casino. What's your view on sports? Is it a loss leader, or do you think that should be driving revenue in its own right?
Sports is again, are the first lens by which we look at it. It's just an entree to mobile gaming, and in America, since so many states are sports only, you have to be in sports to be in mobile gaming, or be in gaming in that state, or to have the first product that complements your physical gaming to that mobility. So we have to be there. Look, I am fully aware of the weaknesses of the current sports betting environment. Forget about the fact that it's super promotional. Forget about that for 1 second. That's just an early stage, thing. But the business itself, the money line, that's a tough business. It's a skill-based business. It's a variable odds business. It's hard to balance the action. You have offshore competitors that don't pay taxes. It's just a lot going on with that business that may never structurally be that theoretical, high single digit, it may never. As much as we spent a lot of time and money trying to create a product that's, me too to the current, generation of, what I call sports bingo, like, if you think about, there's nothing really sport about this this user interface and experience, which is ours. This one happens to be ours, but it's not. It's like everyone else's, right? Like, this one again, it's a bingo card, right? This is a bingo card, right? This is not the sports is almost ancillary. It's just a reveal, right? It's a bingo card, like a ball flopping up and say, N24, home run by, like Aaron Judge. Oh, it's like, it's not, I think that interface will change in dramatic ways. And I think that we have an incentive to change it as much as anyone else does. So yeah, we're moving forward on that.
Well, thanks so much for stopping by today. It sounds like you got 53 emails during the podcast, so you must be super busy, and I really appreciate you stopping by.
Okay. Well,
before I let you go, what do you want to be when you grow up?
What did I want to be when I grew up?
What do you want to be?
Oh, what do I want to be when I grow up? Wow, that's an interesting question. When I was growing up, I wanted to be an astronaut. Obviously, that didn't work. I was scared of heights too, so none of that actually ended up working.
Well, it's back in vogue now, so
yeah, but what? Yeah, no, but not like that. Not like rich guy astronaut. That's kind of annoying. That annoys me. What do I want to be when I grow up? It's a good question. I don't know. Honestly, I enjoy what I'm doing. It's I believe that it's a real, it's interesting. We being in the business of turnaround, you almost have to have like this belief that you can change the world as you see it, right? Because like the business is failing, right? Or like it's just no one likes it, and like you just have to go in and say, you know what, this needs to change for XYZ reasons, and you just impose the change on it. It doesn't always work. But when it works, it's just, it's great. It's very rewarding because you feel like you've made a difference, like you've actually changed the outcomes. And so for me, I enjoy what I do. I think, in different forms, I'll continue to do this thing for some time, so.
Great.
We'll see.
Nailed it.
All right.
Well,
thank you.
Well, thanks so much. Thank you so much for joining us.